mechanisms that firms use to share cash flows with investors. The firm's board of directors makes the decision how much dividends, if any, to pay out, and unlike the coupon payments on a bond, which are promised and contractually obligated, there's no obligation for a firm to make a dividend payment. Having said that, dividend policies tend to be pretty sticky. That means that if companies have paid dividends in the past, they will more than likely to continue paying dividends in the future. And the reason that companies don't like to cut dividends or quit paying dividends if they've paid them in the past is because they fear they will be sending a signal to the market that they're not comfortable, that the company is not comfortable with its earnings power going forward. Now, if companies pay out all their cash flows in dividends, they don't have anything left to make investments that could grow the firm in the future. In other words, they can't buy equipment and other types of investments. Also, before dividends are paid to common stockholders, any past due dividends owed to preferred stockholders are going to have to be paid first. There is an expectation that eventually all companies will pay a dividend. A good example of that is Microsoft. For the first 30 some odd years of Microsoft's existence, it did not pay dividends. And the reason it didn't pay dividends is because the managers felt like they had great growth opportunities and they could earn a higher rate of return for their investors than the investors could earn somewhere else in a similar risk investment. But eventually, even Microsoft found that it didn't have that many good investments and it had more cash than it could effectively invest, and it began paying dividends somewhere around 2000-2001. So not all firms pay a dividend. In fact, Berkshire Hathaway does not pay dividends, and that's because Warren Buffett feels like they can earn a higher rate of return with your money than you could earn it on your own. And here's a quote from Warren Buffett. Another reason firms don't pay out dividends is agency issues. So the nice thing about cash, if you're a CEO, is that there's a cushion there. So if things go bad, you've got cash and the firm is not likely to become insolvent. And for pure career concern issues, you don't want to be the CEO of a firm that's insolvent or illiquid. It's a good way to lose your job. So very often managers will want to hold on to more cash than they really need. So what is preferred stock? Preferred stock is kind of like a hybrid. It's not really debt and it's not really equity. It occupies a middle space. So preferred stockholders are not guaranteed a preferred stock dividend, but they are promised to receive dividends before common stockholders can. Like a bond, preferred stock dividends are fixed amount of face value and they don't change. Unlike a bond and more like a common stock, there's no maturity date on preferred stock, although some preferred stocks have a conversion feature that after so many years they'll convert to common stock. Preferred stockholders are promised a fixed periodic dividend, which is stated either as a percentage of the face value or as a dollar amount. So in much the same way that bondholders receive coupon payments, preferred stockholders received preferred stock dividends. Par value preferred stock is a preferred stock with a stated face value that is used with a specified dividend percentage to determine the annual dollar dividend. So for example, if we had a 5% dividend on a $100 par value stock, that would mean each year the preferred stock dividend was 5% of that $100 face value, or $5. Now, no par preferred stock is preferred stock with no stated face value, but instead it simply has a stated dollar annual dividend. Again, preferred stock is often considered to be quasi-debt because, like debt, it features a fixed periodic payment. So for preferred stock, that's a fixed periodic preferred stock dividend, whereas with debt, with a bond, we'd have a fixed periodic coupon payment. However, a preferred stock is more like a common stock and unlike debt in that it has no maturity date. And because preferred stockholders have a fixed claim on the firm's income that takes precedence over the claim of common stockholders, preferred stockholders are exposed to less risk. Very similar to the restrictive covenants in the bond's indenture, preferred stock can also have restrictive covenants, and these covenants may include provisions about what happens when dividends are missed, the sale of senior securities, in other words, senior to the preferred stock, any asset sales. So if you are a preferred stock holder, you don't want the company selling a lot of assets because there's not an asset base that generate the cash flow to pay those dividends. And you also, if you're a preferred stock holder interested in receiving that preferred stock dividend, you would like the company to maintain liquidity. In other words, you'd like them to have sufficient cash on hand to make sure that they can pay you. And there also may have some restrictions on repurchases of common stock, because again, that would deplete the firm's cash and make the preferred stockholders' claim on the company less valuable, less secure. Two general types of preferred stock with respect to how dividends are paid. There's cumulative preferred stock, which means that if a company quits making preferred stock payments, before it can begin paying common stockholders any dividends, it has to pay all those missed preferred stock dividends in arrears. Whereas non-cumulative preferred stock means that unpaid dividends do not accumulate. However, even with non-cumulative preferred stock, the preferred stockholders have to be paid that period's dividend before common stockholders can be paid dividends.